Most people hear the word stocks and quietly feel like they already missed the train. Maybe you're over 40, maybe you've raised kids, paid bills, survived a few hard years, and now you look at your savings and think, is this really enough? And then someone says, just invest, like it's easy. But nobody tells you what to do when you don't have much. Nobody explains how small money, handled patiently, can start behaving like something much bigger. Here's the part most beginners never hear. The stock market is not only for people with large accounts, fancy degrees, or perfect timing. It rewards something far less glamorous. Consistency, time, nerves, and the ability to stop touching the money every time the world gets loud. In this video, we're not going to pretend that little money magically becomes millions overnight. That's not real life. But we're going to walk through how ordinary people, starting later than they wanted, can still build something serious, one quiet decision at a time. Let's start with the part that makes most beginners uncomfortable. Little money feels slow. That's the honest truth. When you put $50 or $100 or even $200 into an investment account, nothing dramatic happens. Your life does not change. The bills are still there. The car still needs gas. The grocery receipt still looks a little higher than it should. And when you check the account a few days later, maybe it's up $3. Maybe it's down $7. And a quiet voice inside you says, what's the point? That voice is the reason many people never build wealth. Not because they are lazy, not because they are foolish, but because the beginning of investing feels almost insulting. You finally decide to take your money seriously, and the first reward is patience. No applause, no big number, no proof that it's working. But the stock market has always been strange that way. It does not reward the person who needs to feel rich right away. It rewards the person who can keep going while the results still look small. Think about a tree. When you plant it, there is nothing impressive to show, just dirt, water, and faith that something is happening under the surface. For a long time, the growth is invisible. The roots spread before the trunk rises. The strength forms before the beauty appears. Investing is like that. Most beginners want branches before roots. They want the big account, the passive income, the freedom, the comfort, the feeling of finally being safe. But the first stage is not about looking successful. It is about becoming the kind of person who can hold money long enough for it to grow. And that is harder than it sounds. Because by the time you are 40 or older, money usually has a history with you. Maybe you remember not having enough when you were young. Maybe you remember watching your parents struggle. Maybe you worked hard for decades and still feel like you are one emergency away from starting over. Maybe you made a few financial mistakes you do not like to talk about. Maybe you waited too long, trusted the wrong person, bought the wrong thing, or simply spent years trying to survive instead of planning ahead. So when someone says, just invest, they are not just talking to your calculator. They are talking to your memories. They are talking to the part of you that does not want to lose again. That is why beginners often make the same mistake. They look for certainty before they begin. They want the perfect stock, the perfect time, the perfect strategy, the perfect guarantee that this will not hurt them. But investing does not begin with certainty. It begins with understanding. And the first thing to understand is this: stocks are not lottery tickets. At least they should not be treated that way. A stock is a small piece of ownership in a real business. When you buy shares, you are not just buying a blinking price on a screen. You are buying a tiny claim on the future work, sales, profits, and value of that company. Now, that does not mean every company is good. It does not mean every stock will go up. Some businesses fail, some are overpriced. Some are exciting on the outside and weak underneath. That is why beginners have to be careful with the idea of picking winners. Because when you are just starting, your biggest advantage is usually not knowing which single company will explode. Your biggest advantage is avoiding the mistake of betting everything on one story. A lot of people hear about stocks through stories. A friend says he doubled his money. A video says one company is about to change the world. Someone at work talks about a stock like it is a secret door. And suddenly, investing starts to feel like a room where everyone else knows something you do not. That feeling is dangerous. Because when you feel behind, you rush. And when you rush, you stop thinking like an owner and start acting like a gambler. The calmer path is different. it is quieter. It does not make people lean across the table and say, "You have to get in now." It sounds almost boring. Broad funds, consistent contributions, long-time horizons, reinvested growth, not exciting but powerful. For many beginners, the simplest starting point is not trying to find the one perfect stock. It is learning how the overall market works through diversified investments like index funds or ETFs that hold many companies at once. Instead of placing your future on the back of one business, you own small pieces of many businesses. Some will disappoint, some will thrive, some will disappear. Some will become giants. But you are not depending on one name to carry your entire future. That matters, especially when you are starting with little money, because little money cannot afford big emotional mistakes. When you only have a small amount invested, the temptation is to make it move faster. You may think, "I don't have 20 years, I need something bigger." But that thought can lead people into risky trades, hype, panic, and disappointment. They try to make small money behave like big money overnight and end up losing the one thing that could have changed everything: the habit. The habit is the real beginning. Not the first stock, not the first $100, not the first green day. The habit. Can you set aside money before life finds a reason to take it? Can you invest when the news is noisy? Can you keep going when the balance looks boring? Can you stop measuring progress every week and start thinking in years? That is where the transformation starts, because little money invested once may stay little, but little money invested again and again becomes a machine. At first, you are doing all the work. You put money in, and it feels like you are pushing a heavy cart uphill. But over time, if the money is invested wisely and allowed to compound, the account begins to contribute more of its own growth. The cart does not become weightless. There are still bad years, still drops, still fear, but something changes. Your money is no longer just sitting there waiting to be spent. It is working, quietly, in the background. And this is the part many people underestimate. Wealth often looks invisible while it is being built. It does not always look like a new car or a bigger house. Sometimes it looks like driving the same car a few more years, not upgrading the phone, not trying to impress people who are not paying your bills. It looks like choosing future peace over present applause. That is not glamorous. But it is grown up. And for many people over 40, that is the season they are really entering. Not the season of pretending, not the season of chasing every shiny thing. The season of asking, what actually works? What can I repeat? What will I be glad I did 10 or 15 years from now? Because the goal is not to look rich. The goal is to stop feeling fragile. And stocks, when approached with patience and respect, can be one of the tools that helps you do that. Not because they are magic, not because they erase every problem, but because they give ordinary money a chance to participate in extraordinary time. That is the door most beginners miss. They think the question is, how much do I have? But the better question is, how long can I keep building? Because millions are rarely created by one perfect move. They are usually created by small moves that were not interrupted. Now let's talk about the thing that quietly separates beginners who build wealth from beginners who stay stuck. They stop trying to make investing feel exciting. That sounds strange because everything around money today is designed to make you feel behind. There is always somebody online showing a bigger gain, a faster result, a smarter move, a stock they bought before everyone else saw it coming. And when you are starting with little money, especially after 40, that noise can hit a sensitive place. It can make you feel like patience is for people who already have enough, and risk is the only way to catch up. But that is where many people get hurt. They do not lose because they are investing. They lose because they are trying to repair 20 years of delay in 20 days. And the market is not kind to desperation. It can smell it. Not literally, of course, but in the way desperate people behave. They buy too late because they cannot stand missing out. They sell too early because they cannot stand being afraid. They jump from one idea to the next because sitting still feels like doing nothing. But sometimes, sitting still is the work. Sometimes, not touching the account is the most mature financial decision a person can make. Think about it like this. If you were building a house, you would not dig up the foundation every weekend to see if it was working. You would not move the walls because your neighbor said another layout was better. You would not panic because the house looked ugly halfway through construction. You would understand that unfinished things look uncertain before they look solid. Your investment account is the same way. In the beginning, it may not look like wealth. It may look like a few shares, a small balance, a number that does not impress anyone. But the purpose of the early years is not to impress. The purpose is to establish ownership. Ownership changes something inside a person. When you own even a small piece of productive companies, you begin to see the economy differently. You are no longer only the consumer buying the product, paying the subscription, filling the gas tank, using the phone, shopping at the store. You are also, in a small way, on the ownership side of the table. That does not mean life becomes easy. It does not mean every investment works. But it does mean your money has been moved from the world of pure spending into the world of potential growth. And that shift is bigger than it looks. For a beginner, one of the most important lessons is that wealth is not just built by earning. It is built by keeping, directing, and protecting. Plenty of people earn good money and still feel broke because every dollar already has a place to disappear. The mortgage, the insurance, the credit cards, the car payment, the kids, the repairs, the medicine, the taxes, the little emergencies that never ask permission. Life can become a hallway of open doors, and every dollar walks out before you even meet it. Investing forces you to close one door and say, "No, this part stays with me." Not for a vacation, not for a quick purchase, not for a moment of relief. This part is for the older version of me. And if you are over 40, that sentence carries weight, because the older version of you is not imaginary anymore. You can see that person getting closer. You can feel time moving differently. You know what 10 years means now. You know how quickly a decade can pass when you are busy surviving it. That is why investing little amounts can be more powerful than it feels. The money matters, yes, but the decision matters too. Every contribution is a vote. A quiet vote for stability, a quiet vote against panic, a quiet vote that says, I may not be able to fix everything today, but I am not abandoning my future. And there will be days when that vote feels small. There will be months when the market drops and your account looks worse, even though you did the right thing. That is the emotional test. Beginners often think the test is finding the best investment, but the deeper test is staying sane while a good investment temporarily looks bad. Markets move, sometimes sharply, sometimes for reasons that sound terrifying. Recessions, elections, inflation, interest rates, wars, bank problems, unemployment numbers, headlines written to make calm people nervous. If you wait for the world to feel safe before investing, you may wait forever. The world rarely feels safe in real time. Looking backward, the past looks obvious. Looking forward, everything looks foggy. That is why a simple plan matters. Not a perfect plan, a simple one. A plan that tells you what to do when you are confident, and more importantly, what to do when you are not. Because your emotions will not always be trustworthy. Some days, fear will sound like wisdom. Some days, greed will sound like opportunity. Some days, doing nothing will feel irresponsible, even when doing nothing is exactly what your plan requires. This is why many beginners benefit from automation. Automatic investing removes some of the drama. The money goes in before you debate with yourself, before the news scares you, before life offers you 10 other ways to spend it. It turns investing from an emotional event into a household rhythm, like paying the electric bill or filling the fridge. Not because it is easy, but because it becomes normal. And normal is powerful. The people who build wealth are not always the smartest people in the room. Many times, they are the ones who made the boring thing normal for long enough. They bought consistently, they diversified, they reinvested, they avoided the big mistake. They let time do what time does. And then one day, the account that once felt pointless starts to feel meaningful. Not because it exploded overnight, but because the roots finally became visible. That is the quiet miracle of investing. It does not ask you to become someone else. It asks you to become steady. And steady over enough years can look almost unbelievable. The next layer is where beginners either become investors or stay spectators, understanding that the stock market is not one thing. People say the market as if it were a single creature with one mood, one direction, one decision. But when you invest, you are stepping into a living collection of businesses, industries, ideas, mistakes, innovations, cycles, disappointments, recoveries, and human behavior. Some companies are growing, some are shrinking, some are quietly producing cash year after year, some are surviving on hope and borrowed money, and a beginner who does not understand that can easily confuse motion with progress. A stock going up does not automatically mean it is a good investment. A stock going down does not automatically mean it is a bad one. Price is what people are willing to pay today. Value is what something may actually be worth over time. And those two things do not always walk together. Sometimes price runs ahead of value like an excited child. Sometimes price falls behind value like someone who has lost confidence. The beginner's job is not to predict every step. The beginner's job is to avoid being emotionally dragged by every step. This is why broad investing can be so powerful. When you buy a diversified fund, you are not trying to guess which company will be the hero of the next decade. You are saying, I believe productive businesses, as a group, will continue trying to solve problems, sell products, improve systems, earn profits, and adapt. That belief is not blind optimism. It is a practical understanding of how wealth has often been built over long periods. Businesses compete. Some fail. Some become stronger. Some return money to shareholders. Some reinvent entire industries. And when you own a broad slice, you give yourself exposure to that long engine without needing to be right about every individual part. For a beginner, especially someone starting with little money, that can be a relief. Because you do not need to turn investing into a second full-time job. You do not need to wake up every morning and study charts like your retirement depends on guessing tomorrow's candle. You do not need to chase every hot company with a dramatic story. You need a structure you can understand, repeat, and live with. That last part matters more than people think. The best investment plan is not the one that sounds impressive at dinner. It is the one you can actually stay with during an ugly year. Anyone can say they are a long-term investor when the account is green. The truth shows up when the account drops and the headlines start using heavy words. Crash, crisis, collapse, recession, bubble, panic. Those words are designed to reach straight into the nervous system. And if you are over 40, they may bring back memories. Maybe you remember 2008. Maybe you remember watching people lose homes, jobs, confidence. Maybe you remember the pandemic shock, the market falling fast, the uncertainty in the air. So when the market drops again, it does not feel like a chart. It feels personal. It feels like history knocking. That is why risk tolerance is not just a number in a questionnaire. It is your real ability to keep breathing when your money is moving the wrong way. Some people think they can handle risk until risk arrives. Then they discover their plan was built for a calm version of themselves, not the frightened version. A mature investor respects that. You do not build a plan for who you wish you were. You build a plan for who you actually are. If watching your account fall 30% would make you sell everything at the worst moment, then you need a mix that lets you sleep. Maybe that means not being 100% in stocks. Maybe that means having an emergency fund before investing aggressively. Maybe that means keeping debt under control, so you are not forced to sell investments to survive a bad month. This is not weakness. This is wisdom. Because wealth is not only about maximizing returns. It is about staying in the game. A person who earns slightly less but never panics may end up far ahead of a person who chases the highest return and quits during the first storm. Staying in the game is underrated. And the way you stay in the game is by giving your money a job and giving your emotions a boundary. Your emergency fund has one job: protect you from life. Your investment account has another job: grow for the future. Your monthly budget has another job: keep the whole system alive. When these jobs are mixed together, everything becomes stressful. People invest money they might need next month, then panic when the market dips. Or they keep all their long-term money in cash because they are afraid of losing anything, and inflation quietly eats the value year after year. Both mistakes come from the same place: not knowing which money is for now and which money is for later. That distinction can change everything. Money for the next few months should not be treated like money for the next 20 years. Rent money, medical money, emergency money, short-term savings, that money needs safety and access. But money meant for your older self needs growth. It needs the chance to breathe. It needs time away from your daily fear. And that is why beginners must stop asking only, "What should I buy?" and start asking, what is this money for? Because the answer changes the strategy. If the money is for next year, the stock market may be too rough. If the money is for retirement 10, 15, or 20 years from now, then avoiding growth may be its own kind of risk. Quiet, polite, invisible risk, but risk all the same. Inflation does not knock on the door and announce itself. It simply makes yesterday's dollars weaker. You feel it at the grocery store, in insurance premiums, in property taxes, in the repair bill that somehow became twice what it used to be. So when people say stocks are risky, they are not wrong. But keeping all your money out of growth forever can also be risky. The question is not how to avoid risk completely. The question is which risks you are willing to manage, and which risks you are accidentally accepting because they feel familiar. For many Americans over 40, the familiar risk is doing nothing. Waiting until there is more money. Waiting until the kids are grown. Waiting until the debt is gone. Waiting until the economy is clear. Waiting until life is less complicated. But life rarely sends a formal invitation saying, now is the perfect time to begin. More often, you begin while things are still imperfect. You begin with a small automatic contribution. You begin by learning the difference between a single stock and a broad fund. You begin by building an emergency cushion. You begin by not trying to impress anyone. You begin because the future is coming whether you prepare for it or not. And once that truth settles in, investing stops feeling like a rich person's game. It starts feeling like a responsibility. Not a heavy, shame-filled responsibility. A quiet one. The kind that says, I may not control the market. I may not control the economy. I may not control the past. But I can control the next deposit. I can control the plan. I can control whether I keep abandoning my future every time the present gets loud. That is where small money starts to become serious. Not because the amount is large, but because the intention is. Now we need to talk about the word that makes small investors rich, but only after it makes them uncomfortable: compounding. People hear that word and think it is just math, a chart, a formula, something a financial advisor says while pointing at numbers on a screen. But compounding is not just math. Compounding is behavior that survived long enough to be rewarded. It is what happens when your money earns money, and then that earned money stays in the account long enough to earn more money. At first, it is almost invisible, painfully invisible. You invest a small amount, and the growth feels like loose change. You may look at the account and think, this is not going to change my life. And in the first month, maybe it will not. In the first year, maybe it still feels small, but compounding does not reveal itself to impatient eyes. It works like age. You do not notice it day by day, and then one morning you look in the mirror and realize time has been doing its work the whole time. Money can be like that too. The problem is that most beginners interrupt the process before it becomes impressive. They invest for a few months, get bored, stop contributing, pull the money out, chase something hotter, or decide it is too late. They judge a long-term machine by short-term results. That is like planting an apple tree and getting angry because it did not feed your family by Friday. The tree was never the problem. The expectation was. And if you are starting after 40, expectations matter. You may not have 40 years like someone who began at 22. That is true. We do not need to pretend otherwise. But you may still have 15, 20, 25, maybe even 30 years of financial decisions ahead of you. And those years can still matter deeply. The mistake is thinking, because I did not start early, I should not start at all. That is the kind of thought that sounds logical when you are tired, but it steals from you twice. It punishes you for the past, and then it robs the future too. A better thought is, I cannot recover yesterday, but I can stop losing tomorrow. That is a grown-up sentence. Not dramatic, not flashy, just true. And once you accept it, the question becomes practical. How do you give compounding something to work with? First, you need regular contributions, not heroic contributions, regular ones. A beginner often waits for a big lump sum, but wealth usually grows from repeated deposits that feel almost too ordinary to matter. $100, $200, $500, whatever fits your real life without turning your household into a pressure cooker. The amount should stretch you a little, but not break you. Because if the plan is too painful, you will quit. And a smaller plan you keep is better than a bigger plan you abandon. Second, you need reinvestment. When investments pay dividends or produce gains, many beginners want to take that money out because it feels like a little reward. But in the wealth building stage, reinvesting can be powerful because it keeps more workers inside the factory. Think of every invested dollar like a quiet employee. Alone, one employee cannot do much, but every month, you hire a few more. Then the old employees help hire new ones. At first, you are the only one doing the hiring. Later, the system begins helping you. That is compounding. Your dollars slowly recruiting more dollars. Third, you need time without constant interference. This is where maturity enters. Because the market will test your hands. It will tempt you to touch things. It will make you feel smart right before humbling you, and it will make you feel foolish right before recovering. If you react to every mood, you never give compounding a stable place to work. It is like trying to bake bread while opening the oven every 2 minutes. You say you are checking on it, but really, you are ruining the heat. A lot of investing success comes from leaving the oven closed. Not forever, not blindly, but long enough for the process to matter. Now, this does not mean you never review your investments. It means you review them with a plan, not with panic. Maybe once or twice a year, you look at your contributions, your allocation, your fees, your progress, your emergency fund, your debt, and your goals. You ask, does this still fit my life? Not, what did the market do this morning? That difference is everything. One question builds stability. The other feeds anxiety. Beginners also need to understand fees because fees are quiet leaks. They do not look dangerous at first. 1% here, a little expense ratio there, a trading cost, a management fee, something hidden inside a product that sounded sophisticated. But over many years, small leaks can drain a large bucket. This is another reason simple investments can be attractive. Low-cost broad funds do not sound exciting, but they often let more of the return stay with the investor. And when you are starting with little money, keeping more of what you earn matters. You do not need a complicated product to prove you are serious. Sometimes seriousness looks like simplicity. Another thing, do not confuse activity with intelligence. Many beginners think smart investors are always moving, always buying, always selling, always reacting. But a lot of wealthy people became wealthy by making a few solid decisions and repeating them for years. There is a dignity in that. It is not laziness, it is restraint. And restraint is rare now. We live in a world that trains people to respond immediately. A notification appears, we tap. A headline appears, we worry. A stock moves, we react. But investing asks for a different muscle. It asks you to slow down when everyone else speeds up. It asks you to remember that your future is not built by the loudest day in the market. It is built by the quiet pattern you refuse to break. And here is where the phrase, little money into millions, must be treated carefully. It is possible for small amounts to become very large over long periods, especially with consistent investing and strong market returns. But it is not a magic trick, and it is not guaranteed. The point is not to worship the word millions. The point is to understand the path. Earn, save, invest, reinvest, diversify, avoid panic, reduce unnecessary fees, increase contributions when life allows, and give the whole process enough time to breathe. That path may lead one person to millions. It may lead another person to a much stronger retirement than they thought possible. It may give someone else the first real feeling of financial breathing room in their life. All of those outcomes matter, because money is not only about the final number, it is about what changes inside you when you stop drifting. When you have a plan, you carry yourself differently. You may still have problems, but you are no longer just reacting to every expense like life is pushing you from behind. You begin to feel a quiet line forming between today and tomorrow. And that line gives you something many people are missing. Direction. Not perfection. Direction. That is what investing can give a beginner. A direction for money that used to disappear. A place for hope that is not fantasy. A system that does not require you to be brilliant, only consistent. And maybe that is the most overlooked truth of all. You do not need to become a genius to begin. You need to become someone who can repeat the right small action long enough for it to stop being small. The next thing a beginner has to learn is that the stock market will not fix a broken financial life by itself. That may sound disappointing, but it is actually freeing. Because once you understand that investing is only one part of the machine, you stop asking it to do every job. A lot of people come to stocks carrying too much pressure. They need the market to rescue them from debt, from years of late starts, from low savings, from regret, from the fear of retirement, from the feeling that time moved faster than they expected. And when you put that much emotional weight on an investment account, every market dip feels like betrayal. But stocks are not a rescue boat. They are a field. You plant there, you tend it, you let seasons pass. You do not run into the field during a storm and scream at the soil because the harvest is not ready. You respect the process, and part of respecting the process is getting your financial house in order around the investing plan. That begins with cash, not glamorous cash, not money that makes you feel like an investor at a dinner table, just an emergency fund, a buffer, a little wall between you and chaos. Because if every unexpected bill forces you to sell investments, then your portfolio is not really long-term. It is just a savings account with market risk. And that is dangerous. Imagine investing steadily for 2 years, then your transmission fails, or a medical bill shows up, or work slows down, and you have to pull money out while the market is down. That can break your confidence. Not because investing failed, but because the foundation was not ready. So before someone tries to turn little money into millions, they need to make sure little emergencies do not keep stealing the little money. That is why an emergency fund is not separate from investing. It protects investing. It gives your stocks permission to stay invested when life gets rough. And life does get rough. Especially after 40, you know that already. Things break. People need help. Income changes. Parents age. Kids need support. Health surprises you. The house always has one more repair waiting in the shadows. So the question is not whether life will interrupt your plan. The question is whether you have built a plan that can absorb interruption without collapsing. Debt is another part of this. Not all debt is the same, but high-interest debt is like trying to fill a bucket while someone drills holes in the bottom. You can invest, yes, but if credit card interest is quietly eating you alive, the math and the stress can work against you. There is a kind of debt that does not just take money, it takes calm. It makes every paycheck feel already spoken for. It makes investing feel impossible because the future keeps losing to the past. And sometimes, the best investment a beginner can make is paying down the kind of debt that keeps charging them for yesterday. That does not sound exciting. Nobody brags about reducing a balance the way they brag about buying a stock, but reducing financial pressure creates room. And room is where better decisions happen. When you are suffocating, every choice becomes urgent. When you have room, you can think. You can wait. You can say no. You can invest without needing the market to save you by Friday. That emotional space may be worth more than people realize. Now, once the foundation is stable enough, the beginner needs to decide how much to invest. And here is where many people get trapped by shame. They hear someone say, "You should invest 15% of your income," or "max out your retirement accounts," and they immediately feel defeated. But personal finance is called personal for a reason. A target can guide you, but your real life has to be considered. If you can start with 3%, start with 3%. If you can start with $50 a week, start there. If all you can do right now is $25, do not insult it, respect it. The first amount is not just money. It is proof that you are becoming someone who invests. And once the habit exists, it can grow. When the car is paid off, increase it. When a raise comes, increase it before lifestyle absorbs it. When a debt disappears, redirect part of that payment toward your future. This is how ordinary people build serious accounts without feeling like they suddenly changed their whole life. They do not always make one massive sacrifice. They capture small openings before those openings disappear. A paid-off bill becomes an investment contribution. A tax refund becomes a deposit instead of a spending weekend. A raise becomes future security instead of a bigger monthly lifestyle. This is quiet work. Nobody sees it. Nobody claps. But 10 years later, you see it. You feel it. And that is the kind of approval that actually matters. Another important layer is where you invest. For Americans, Retirement accounts can be powerful tools because they may offer tax advantages. A 401k, especially with an employer match, can be one of the first places to look because a match is not magic, but it is real money your employer may add when you contribute. Ignoring a good match can be like walking past part of your compensation. Then there are IRAs, traditional or Roth, depending on your situation. These accounts are not just technical details, they are containers. And the container matters because taxes matter. The same investment inside a better tax structure may leave you with more later. But do not let the account names intimidate you. A beginner does not need to master every rule in one night. You learn step by step. First, understand what options you have. Then understand whether there is a match. Then understand fees. Then understand the investments inside the account. Then build the contribution. Wealth is often built by people who are willing to be beginners longer than their ego wants them to be. That is a powerful sentence, because ego is expensive. Ego says you should already know. Ego says asking basic questions is embarrassing. Ego says you need a complicated portfolio so people think you are sophisticated, but your future does not care if you sounded smart. Your future cares if you made decisions that worked. Simple and correct beats complicated and fragile, every time. And as you build, you also need to protect yourself from stories that are too perfect. Anytime someone makes investing sound effortless, guaranteed, urgent, or secret, slow down. The market does not need you to rush. Salespeople often do. Hype often does. Fear often does. But a good long-term plan can survive a calm night of thinking. It can survive reading the fine print. It can survive asking, what are the fees? What are the risks? What happens if this goes wrong? Do I understand this well enough to own it? That question alone can save beginners from painful mistakes. Do I understand this well enough to own it? Not well enough to repeat what someone said, not well enough to feel excited, well enough to own it when it falls. Because ownership is tested on the way down. And when you understand what you own, you are less likely to panic just because the price moved. You may still feel fear, everyone does. But fear does not have to drive the car. It can sit in the passenger seat and complain while the plan keeps steering. That is maturity, not the absence of emotion, the ability to continue while emotion is present. And maybe that is why investing after 40 has a different beauty to it. You are not investing with the innocence of someone who thinks life will be smooth. You are investing with scars, with memory, with a better understanding of what money can and cannot do. You know money will not make life perfect, but you also know that not having enough can make hard moments harder. So you invest not to become someone else, but to give yourself more choices, more breathing room, more dignity, more ability to help without destroying yourself, more ability to age without carrying constant financial fear in your chest. That is the real goal beneath the word millions, not the number itself, the feeling that your future is no longer being ignored. If you are still here with me near the end of this video, I want to invite you to subscribe to this channel and come with us every day. Not because subscribing will change your finances by itself, but because hearing the right ideas repeatedly can help you stay steady in a world that keeps trying to make you reactive. And if you are over 40, you already know this. The hardest part is not finding information. The hard part is staying grounded long enough to use it. So let's go back to the real question. How does little money become something large? It becomes large when you stop treating it like leftover money and start treating it like assigned money. That is a quiet but serious difference. Leftover money has no authority. It waits until the end of the month, after life has taken what it wants, and then you hope something is still there. Assigned money is different. Assigned money has a name before the month begins. It says, this part is not available for impulse, pressure, boredom, or guilt. This part belongs to the future. That may sound simple, but for many people, it is the first time they have ever given their future a seat at the table. Most of life teaches us to respond to what is loud. The bill is loud. The sale is loud. The family need is loud. The broken appliance is loud. The market headline is loud. But the future is quiet. Retirement does not knock on your door at 45 and say, please prepare for me. It waits. And then one day, It is not the future anymore. It is the room you are standing in. That is why the beginner's journey is not just about picking investments. It is about learning to hear quiet things before they become urgent. A quiet contribution, a quiet habit, a quiet refusal to spend money just because it is there. A quiet decision to increase your investment by 1% when your income rises. These things do not feel dramatic in the moment, but they are the architecture of financial peace. And there is another truth here that people do not like to say out loud. Most financial damage happens gradually before it happens suddenly. A little lifestyle creep, a little high-interest debt, a little delay, a little fear, a little, "I'll start next month." None of it feels catastrophic alone. But years later, those small decisions have formed a life. The good news is that the opposite is also true. Financial strength is built gradually before it becomes visible. A little investing, a little debt reduction, a little emergency fund, a little learning, a little patience, a little refusal to panic. At first, nobody can see it. Maybe even you cannot see it. But you are changing the direction of the current, and direction matters more than speed at the beginning. A person moving slowly in the right direction may end up far ahead of a person running in circles. This is where beginners must become careful with comparison. Comparison is one of the fastest ways to ruin a good plan. You see someone younger with more money, someone your age with a bigger house, someone online with a portfolio that makes yours look tiny. And suddenly, the plan that was working starts to feel embarrassing. But you do not know the full story behind other people's numbers. You do not know their debt, their help, their risks, their stress, their timing, their truth. You only see the surface, and building your financial life based on someone else's surface is a good way to betray your own reality. Your plan has to fit your income, your age, your responsibilities, your temperament, your family, your health, your real life. A plan that looks smaller but survives is stronger than a plan that looks impressive and collapses. And if you are starting with little money, survival matters. Not survival in a desperate sense. Survival in the sense of durability. Can your plan survive a bad market? Can it survive a tight month? Can it survive boredom? Can it survive the temptation to quit because progress is not fast enough? That is what you are really building. Durability. Wealth loves durability. It loves people who keep showing up. It loves the investor who does not need every year to be beautiful. It loves the person who understands that some seasons are for planting, some are for waiting, some are for pruning, and some are for harvesting. The mistake is demanding harvest in every season. There will be years when your account grows nicely. There will be years when your contributions do most of the work. There will be years when the market gives back nothing or even takes some value away on paper. But if you keep buying wisely, those difficult years can become part of the story, not the end of it. Lower prices can feel painful, but for a long-term investor still contributing, they can also mean your new dollars buy more shares. That is hard to appreciate emotionally because nobody enjoys seeing their account fall. But mature investing often requires holding two truths at once. This feels uncomfortable and this may still be useful over time. That is not blind optimism, that is perspective. And perspective is one of the greatest assets an older beginner can have. You may not have started at 22, but you have lived enough to know that panic rarely produces the best decisions. You have seen cycles. You have watched trends come and go. You have learned that people can sound very confident and still be wrong. Use that. Let your age become an advantage, not only a regret. Younger investors may have more time, but older investors can bring more seriousness, more discipline, less need to impress, more awareness of what matters. You may be more willing now to choose boring progress over exciting mistakes, and that shift can change the rest of your life. So when you think about turning little money into millions, do not begin with the million. Begin with the next repeatable action. What amount can you invest every month without destroying your peace? What account should you use first? Are you getting the employer match if one exists? Are your fees low? Are you diversified? Do you have cash for emergencies? Are you carrying high-interest debt that needs attention? Can you increase your contribution slowly over time? Can you stop checking your account like it is a scoreboard and start treating it like a farm? These questions are not glamorous, but they are honest. And honest questions build stronger lives than exciting promises. Because at the end of the day, the market does not know your name. It does not know your regrets. It does not know how late you feel. It does not care whether you are embarrassed to begin. But it does respond over time to capital, consistency, patience, and ownership. That is the language it understands. And the sooner you begin speaking that language, even with small amounts, the sooner your money stops being only something you spend and starts becoming something that can stand beside you. Not today in a dramatic way, not tomorrow in a way that changes everything, but slowly, quietly, then meaningfully. And one day, maybe you look back and realize the first small deposit was not small at all. It was the moment you stopped waiting to become rich before acting like your future mattered. Now, we bring this home. If there is one thing I want you to carry with you after this video, it is this. You do not need to feel ready before you begin. Most people wait for a feeling that never arrives. They wait until they understand everything, until the economy feels calm, until the account balance looks stronger, until the debt is smaller, until the kids need less, until the fear goes away. But fear does not always leave before action. Sometimes it leaves because of action. Sometimes the first small deposit does not change your finances very much, but it changes your relationship with yourself. You become someone who began, and that matters. Because the hardest part of investing for beginners is not opening the account. It is crossing that invisible line between the person who talks about someday and the person who does one quiet thing today. Most people never cross that line because they underestimate small beginnings. They think small money is embarrassing. They think if they cannot invest a large amount, the effort does not count. But money does not become powerful only because it starts big. Money becomes powerful when it is given direction, protection, and time. A small amount invested with consistency may do more for your future than a large amount that arrives one day and disappears because there was never a system to protect it. That is why the real lesson here is not find a hot stock. It is not beat everyone. It is not get rich fast. The real lesson is quieter. Build the habit. Respect diversification. Keep your costs low. Reinvest. Protect yourself with cash. Avoid high-interest debt when you can. Increase your contributions when life gives you room. And when the market gets loud, return to the plan instead of returning to panic. This is not exciting advice. But most things that change a life are not exciting while they are happening. They are ordinary, almost invisible. A walk after dinner, a difficult conversation, a bill paid off, a dollar invested instead of wasted, a decision not to impress someone, a decision not to abandon yourself. That is how a different future is built. Not in one dramatic moment, but in a long series of moments where you quietly choose stability over noise. And maybe that is the part that matters most for someone over 40. You know by now that life is not as long as it once felt. You know how quickly 5 years can pass. You know how fast children grow, how fast careers change, how fast a decade can disappear into work, bills, responsibilities, and tired evenings. But that truth does not have to make you bitter. It can make you clear. Clear enough to stop wasting years waiting for the perfect moment. Clear enough to stop punishing yourself for not starting earlier. Clear enough to say, this is where I am. This is what I have. This is what I can do next. There is dignity in that. More dignity than pretending. More dignity than giving up. More dignity than chasing some wild promise because patience feels too slow. Stocks for beginners can sound intimidating, but the foundation is deeply human. Own pieces of good businesses through a thoughtful, diversified plan. Keep adding. Let time work. Do not let every headline become a command. Do not let every dip become a verdict. Do not let every regret become a reason to stop. The market will rise and fall. That is what it does. Your job is not to control the waves. Your job is to build a boat that does not fall apart every time the water moves. And that boat is built with discipline, cash reserves, realistic expectations, and the humility to keep learning. Because yes, little money can become something meaningful, sometimes even something very large. But the transformation begins before the number proves it. It begins when you stop seeing your future as a distant stranger and start treating it like someone you are responsible for. The older you is coming, not as a threat, not as a punishment, just as a fact. And one day, that older version of you will live inside the decisions you are making now. Maybe they will not remember every deposit. Maybe they will not remember every month you stayed consistent. Maybe they will not remember every time you wanted to quit and did not. But they will feel it, in the options they have, in the pressure they do not carry, in the quiet relief of knowing someone years earlier cared enough to begin. So do not despise the small amount. Do not laugh at the first deposit. Do not insult the beginning because it does not look like the ending. Every serious financial life has a quiet first chapter. This may be yours. If this video helped you see investing a little differently, follow this channel and stay with us. Share this video with 5 people who need to hear a calmer, more honest conversation about money. And leave a sincere comment below. Tell me where you are starting from, what part of this hit you the hardest, and what topic you want us to talk about in the next video. Because sometimes the future does not begin with a huge breakthrough. Sometimes it begins with a small amount of money, a tired person, and one decision that finally stays.